Welcome to Tradiers, the Trader's Edge. I'm Jim Iuorio. That's Bob Iaccino. Together, we are 2 out of the 3 who are involved at unfilteredinvestor.com with our partner, Mike Arnold. Please check us out there as well. So, Bobby, 2 solid days in the stock market. The president, I don't know. You fill that last part in. That's the only way you can respond.
I don't know.
I don't know. But anyway, so oil's back under 100. Stock market seems good. Are things over, or we're just going back into the rotation zone? What do you think?
Okay, well, let's talk just briefly about crude before we bring our guests on. Crude oil doesn't believe it yet. We had
99.75 right there. Right.
Yeah, we had 2 consecutive days that are lower, but the low today, it held at the simplest of support levels, which for me was the 8-day moving average, right? Which was coming in today right at about 97.80, and the low today is 96.50. And then it rallied up from there. So it held at the simplest of levels. Today is likely to be the 3rd highest close since the crisis began.
Yeah.
So that's not necessarily gold pulling back. Equities are bouncing. For sure, equities are bouncing. And I think the equity markets more believe that the president is going to end this one way or the other. By the way, and we could talk about this with our guests too, it's driving me crazy a little bit with all these people. I saw Nouriel Roubini joining the chorus of "This war's already a failure." And I'm not saying it's a success, but if the reason for the war was to eliminate the possibility of them building more ballistic missiles as well as a nuclear warhead, I think it's very easy to declare victory and possibly be even correct about that.
Sure. It's nuanced. It's mixed. Everybody who says it's a failure is right and they're wrong. And everybody says it's a success is right and they're wrong. And everybody tries to make it into a binary. And it is so frustrating to me. There is good and there is bad. In the end, in the whole bag, you'll figure out what weighs more, the good or the bad. And we're not ready there yet. Anyway, sorry for that quick rant. We are bringing on one of our favorites, a very, very intelligent guy. Like I've said a million times, you may have followed Bobby and I for 25 years on media and think that we're full of shit. We sometimes think we are as well. But the one thing you can't ignore is that we get fabulous guests, and we've made some great contacts along the way. This is one of our favorite guys. Let's bring in Mike Singleton, who is a vice president and portfolio manager at Diamond Capital Management. No beautifully tied ties and perfectly pressed shirts. This is our show now. Anyway, we love Mike Singleton. How are you, brother? Good to see you.
Doing great. Thanks for having me back on the show despite the new apparel.
You actually look good. Now, do you always go with the single Windsor?
I alternate between the 4-in-hand and the half Windsor, depending on the collar, depending on how I'm feeling that day. It's very complicated.
I don't know what the fuck you guys are talking about.
Wait, you don't know the difference between a double and a single Windsor, Bobby, for you tying a tie?
Okay. My dad taught me to tie my tie. And my dad's tie always ended up upside down, and then he would take it off, turn it over, and put it back on. That's how I learned to tie a tie.
So the double Windsor, you go one around there, and then you go. Well, I haven't tied a tie since my daughter's wedding. I think about 2 years ago. Oh no, I actually didn't even then. That was a bow tie.
So what are you doing right now?
What's that?
What are you doing right now?
I'm tying a double Windsor. Can I do that or no? Do we have
No. I don't know what you're doing. I see a tie.
So look, okay, see how mine is wider than Mike's?
Yeah.
And it's supposed to, the purists will say it's more symmetrical, but a lot of the cool kids tie a single Windsor too.
Hey, he just said a 4-in-hand. That's 4 of a kind to me in poker. I don't know what that
Well,
is.
he said 4-in-hand. I think that the same thing as a double Windsor. Is that what you meant?
A 4-in-hand is the narrowest, simplest, least formal knot.
Oh, that's a single Windsor then in my vernacular, I think.
Perhaps. This is the
I have to do some neck
casual tie you could possibly wear. What I'm wearing right now.
Well, I now feel that I'm equally dressed up to my.
Just leave it on. That's how we used to do the floor. Remember, take your tie off and then put it back on in the morning.
Oh yeah, no doubt about it. I was surprised when I pulled it out of my pocket of my trading jacket that it wasn't tied. I thought it would be actually because I haven't had the trading jacket on. Even though I have been on a trading floor for years, I haven't put it on in a while. Figure if they don't know me by now with all the rules I've broken on that trading floor. Anyway, let's get to market. So, Mike, you are at Diamond Capital now. That's really, really cool. And we've always loved your research. We can't start this conversation without talking about crude oil and the ramifications it's going to potentially have for the economic condition. Because I do talk because I love to hear myself talk, but I'm going to just set this up real quick because I think that higher crude prices are definitely inflationary in 3 months to 6 months. But beyond that, I think it's highly recessionary as it starts to bite into people's money. Where do you fall?
So I don't think there's any denying that sharply higher oil prices is one, inflationary, and two, all else equal, reduces real growth. That said, I'm not an alarmist about it. The US economy actually had surprisingly good momentum going into this crisis. We were growing about 2.5% in real terms, maybe a hair faster. And we were actually seeing plenty of evidence of improvement in the most cyclical parts of the economy before then as well. We were seeing it in the PMI data. We were seeing it in the FRB's manufacturing data. We were seeing it in hiring rates in cyclical industries like home builders, like mining, like manufacturing. And so while higher oil prices are not a good thing, you have to think about it relative to what's priced in and relative to what's likely to happen in the future. I don't think we're heading for a recession. And I think if you look out, I think the tape is really sloppy right now. Bobby probably has a better view on that than I do. That said, I think if we look 3 months out, I think expected returns, in my view, still look pretty good for stocks.
Okay, that's good. Bobby?
So let me ask you, Mike, one of the things that's been bothering me over the last few days is, I'm trying to think of who was a recent one. Jimmy, what's the name of the head of the Chicago Fed? Austin Goolsbee.
Austin Goolsbee, yeah, right.
Yeah. He's been talking about the effect of crude oil on headline CPI. A lot of the voting members that I would say are anti the administration have been talking about inflation now. In the past, when there was inflation, don't know if it was a different administration or not, might have been, they were talking about the core. Now, I know historically they look at the core. In your opinion, how long do you think it would take for a headline to bleed into core? 1 cycle, 2 cycles?
I've actually done this analysis before back in my old days at Invictus. And if my memory serves me, it's about 6 to 9 months.
Okay. That actually makes good sense because that then starts to, well, no, it's actually then takes too long for it to start being recessionary right away, or no? Am I looking at it wrong, Mike?
Well, I would think about the relationship between headline and core and oil and core. If you look at the correlation between the spot price of oil and inflation break-evens or inflation expectation, and you'll see it's something like 90%. It's very, very close.
I noticed that when this happened. I had the 2-year breaks up on my chart the whole time. Yeah. Yeah.
Right. And so, the longer crude stays higher, the more, logically higher inflation expectations start to bleed into the consumer consciousness and ultimately bleed into wage growth and how people, negotiate for housing. And ultimately, wage growth and housing account for something like 70% of core inflation. And if you just run a cross correlation analysis, it's over a period. The relationship is strongest over a period of like 6 to 9 months.
Well, that makes sense.
I was looking at Jimmy and I have had this running conversation. Jimmy, for a while, said he doesn't necessarily believe that higher prices at the pump are inflationary because they take away some of the spending power of the consumer because you have to fill your tank. And I think that's almost unmistakably true. When I look at the chart of crude oil prices and then CPI headline, it's about as correlated as anything gets. Does it become more the case that the lack of this excess money to spend because it's been spent at the gas pump leads to just an overall slower economy, possibly recession? Is that the way we should look at it? Not that it's not inflationary?
Well, I think about it first sort of in terms of nominal growth. You could think nominal growth will be roughly the same, but the composition of nominal growth will change.
What do you mean?
I mean, more inflation and less real growth.
Oh, okay. Yeah.
Right. So, there's the same amount of money circulating. It just gets, there's just higher prices and you get less out of it. Right. That's how I think about it with higher oil prices. And then there's also a relationship between oil prices and corporate profits. And, higher oil prices is just a reflection of resource scarcity relative to demand and cost push inflation. And ultimately, if corporate margins get pushed enough, they'll start laying people off. That said, corporate margins are as high as they've ever been right now. Nominal economic growth is still in the range of 5%. Real growth is, 2.5%, or if you're using a very high frequency measure because of oil prices, maybe it's 2%. I don't think that we're at a point where corporations are seriously considering layoffs on the basis of the economic fundamentals yet. Now, I think if we see $100 plus oil for a year, I think that starts to become a much more pressing question. But I think when the U.S. has pretty good momentum, it's like the Titanic, right? The Titanic doesn't turn around all at once. It's it's still the biggest economy in the world by 50%. And it takes a real shock, something akin to government mandate to shut down the whole economy to actually get it to turn around that quickly. And I think that, it would take a sustained period of $100 oil to really cause sustained damage in the form of layoffs, I believe.
Okay, so independent of oil, by the way, I was going to go the direction of the labor market and AI's effect on that, but instead I'm going to go with the overall economy. Because prior to the Iranian thing, I was bullish oil, but I was bullish oil because I believed our economy was going to really have some serious tailwinds in the form of tax cuts. I'm not talking about no tax on tips. I'm talking about expensing in the form of deregulation. That I believe that was more coming down the pipe. And if Donald Trump says there's 162 million trillion investment dollars coming home to roost based on his tariff and negotiations, maybe
when you do that,
maybe 6 trillion of it is correct. You know what I mean? So it's Donald Trump. Again, you people all know, we've talked about this a million times. I am not the hugest fan. I voted for him, but whatever. Do you think those things are still working to counterbalance the deleterious effect of higher oil?
Yeah, I think that's exactly right. I mean, I think that it's very tempting always to sort of ascribe a single reason why the economy or the stock market has to do this or that. And I mean, honestly, again, I'm sure you guys already know this, the inverse correlation between the price of oil and stocks has been very close over the last few weeks. That said, when you're looking out, when you're forming an outlook, you have to sort of consider the weight of the evidence, and there's offsets to things like higher oil prices. I mean, for one, we still have considerable resources in the Strategic Petroleum Reserve. We also have $250 to $300 billion of incoming fiscal stimulus through the end of the fiscal year. We have pretty decent momentum in some cyclical parts of the economy, like manufacturing. So, I mean, I think that the house view here anyway is that some of those offsets enable the economy to continue to grow at between 2.5% and maybe 3% on an inflation-adjusted basis through the end of the year.
So what do you think it's going to look like? You obviously have an opinion about the Iran war, and I don't need you to say it unless you need to say it. What do you think the curve is sort of going to look like, and what part of the business cycle are we in now, since that's sort of the core of your analysis?
So prior to the invasion of Iran and the higher oil prices, I would have said that there's pretty good evidence that we were earlier cycle than I think the consensus believed. It's funny, I've always heard this question asked of macroeconomists and market strategists: what inning are we in? And everyone always says it's the 7th inning. It doesn't matter what conditions are like. It's always the 7th inning, because I think that's a safe answer, right? It's not a recession, but there could be a recession. And if you'd asked me 3 months ago, I would have said that we're probably closer to the 3rd or 4th inning, in the sense that there's a lot of slack in the U.S. economy, right? Housing transaction volumes were and still are down about 40% from their cycle peak, which was all the way back at the end of 2020. We saw the ISM manufacturing PMI below 50 for, I don't know, four consecutive years or something like that. That weakness was also apparent in the hard data, like the industrial production data. The unemployment rate had increased 120 basis points or so off of the cycle trough. So there was a lot of room for improvement, and you had policymakers who were pretty motivated to make things better. The one big beautiful bill was going to provide a good deal of stimulus. I think that's probably still the case, and I think President Trump probably will pull whatever levers he can heading into the midterms. And I believe that the Fed was going to cut. I think that's a little bit more up in the air. I think that the probability of the Fed cutting with $100 plus oil I think that's on pause until something changes. That said, I think if oil returns back to even what futures are kind of pricing in now, maybe to the low 80s or high 70s over the next 6 months, I think cuts could easily be back on the table, especially if we don't see the headline labor market data start to improve a little bit. I would say that we're probably in the fifth inning still. I don't think that we're near a recession. I think that there's still more tailwinds to the economy than headwinds. And generally, that's sort of what informs our constructive or bullish outlook.
Okay, so Mark Andreessen came out in a interview yesterday, and he said that companies are not hiring because of AI. Companies are using AI as a crutch not to hire, but realistically, it was just over hiring in the last pendulum swing, and there's not as much need to hire now. I personally think it's a combination of both. You alluded to something before that almost made it seem like you don't think the labor market is particularly weak. Can you expound on that?
No, I would say the labor market is weak. I mean,
Okay.
The hiring rate is the same as it was in the middle of 2008. It's worse than it was at any point during the dot-com recession. It doesn't look great, in my opinion. That said, the question is always, is it going to look better 3, 6, 9 months from now, or is it going to look worse? I think it'll probably look better. I think hiring is going to improve. I think the unemployment rate is more likely to go down than up. I think income growth and consumption growth are more likely to accelerate by 100 basis points or so rather than decelerate. As far as the AI question, it's hard to say. I will say that one of the implications of overstimulating the economy that really never gets discussed is that you have to hire, each marginal worker you hire is going to be less productive, right? Because you hire the best candidates first, and then you hire the less good candidates after you've hired the good candidates. And so labor productivity goes down as you stimulate and you kind of force people to hire to meet, and then you hoard the labor because all these corporations have experienced these labor shortages, and the result is kind of a bloated, unproductive workforce, and that's a distortion that takes time to work out. And I think artificial intelligence probably is having some impact on the labor market, but I think probably what I think Mark Andreessen's saying is correct. A lot of firms have just overhired relative to, demand as it actually happened between 2023 and today. And so I just think that's going to take a while to resolve. I don't think it's anything more catastrophic than that. It's not good, but it's.
Yeah. So let me jump in then. Generally speaking, do you think the AI, that artificial intelligence more broadly, is wildly disruptive, one of the most disruptive technologies you've seen in your lifetime? What do you think?
Oh yeah, I think so. I mean, I think I could probably say that just based on, I work in research, and I think artificial intelligence is a really, really useful research tool. So from my perspective, it's the best thing since Microsoft Excel, and it's not just a little better. I mean, I think it's a lot better. And the way that I imagine it evolving over the next 5 to 10 years will be great, and I think it'll be really productive. And ultimately, I think it's going to enhance labor. I don't think it's going to replace labor. Something I think people that generally gets forgotten is that all technology exists to serve humans, right? And so if it's not making life better, it probably won't persist in that direction, or it'll be redirected in a way that does make life better. And so that's one of the reasons that I'm ultimately positive on artificial intelligence, and I think it'll result in a higher quality of life. It'll result in better output per employee. I think it'll result in higher quality consumer goods, and I'm not worried about Judgment Day or anything like that, mass layoffs.
Okay. I have just a couple of comments before I ask you a question. One comment was when you said the big beautiful bill, that's the stimulus from that is likely still coming down the pipeline. Anecdotally, I know someone who sold some assets in 2025 and was worried about the tax responsibility for selling those assets. They were offset by the excess tax return that this person is getting. So essentially the capital gains tax is wiped out by the extra tax return they were getting because of the big beautiful bill. And he basically said, I need to go buy myself something. It's just a strange little anecdote, but I think it applies more often than we think. Then I want to show you what its stock charts, whose name is Remo. He texted me this over the weekend. Actually, it was on Monday. Back in 1977, I worked at a Shell gas station making $2.30 an hour minimum wage then. Regular gasoline was 65 cents a gallon, so I made 3.55 times more than the gas. Today's minimum wage in Connecticut, according to the state, is $16.94 per hour. and Shell gas regular as of March 29th was $4 a gallon. So pay gas ratio is down to 4.24%, making gasoline cheaper now than it was in 1977. Do you think that applies anywhere else? I mean, I thought about this, Remo, ever since you sent it to me, because he said everything is relative. Is the entire quote unquote affordability crisis a scam?
No.
Okay.
I think that there's certain parts of the economy that have inflated really quickly. And I think that there are education, housing, and healthcare. I think if you look at the cost of those things relative to incomes, they are, almost insurmountably expensive for regular people. They are.
And before you continue, two of those were driven up by government policies, were they not? Education and healthcare?
And probably housing too.
Fair enough.
No doubt, right?
Yeah,
fair enough.
I would, blame it all on the government.
Yeah.
But yeah, then there's certain parts of the economy that have disinflated over. I just bought a TV for, $900, and that would have been $3,000 15 years ago. And I'd say, generally speaking, commodities have disinflated relative to incomes. And so even though $100 oil is bad and $4 gas is bad, incomes have generally outperformed the price of commodities. It's the services sector where you've seen a lot of regulation, a lot of resource constraints sort of artificially imposed, zoning laws around housing, federal subsidies for education, a million different things. But I mean, yeah, I think the real pain, the real affordability crisis is housing, education, and healthcare. And I don't know that anything is really being done to address that. The cure for higher prices is higher prices in commodities. I'm not sure that's true with housing.
Yeah. By the way, my daughter just bought a 100-inch TV. What did you buy?
It was 55 inches.
55 inches is awesome.
Yeah, I think it's good. It's one of those frame TVs because my wife and I didn't want it to look like a TV. We wanted it to just look like it was a picture of something. So it's Washington crossing the Delaware when no one's watching it.
All right. I just bought a 36-inch one for my office because my old one just went. Yeah. $86.
I was going to say they give those away. That's $86. That's a throw-in when you buy something else. Here, take this TV.
The breakfast I had with Lex the other day was more than the TV that I bought.
That's just amazing. Yeah. Mike, if you could see what we tried to watch sporting events on in, like, let's say 1977, you would be amazed. Like, you couldn't watch a hockey game because you couldn't even see the damn puck, the little black and white TVs we had.
You just saw guys put their hands up and you knew something happened.
Right, exactly. Yes.
I just replaced an older TV and it weighed as much as a car. I mean, it was so it was impossible to lift.
Let's take a quick break here. Luis, will you put up the banner? But before I talk about the banner, I'm going to talk about something else. A unique and rare opportunity to come to a live event with Bobby and I on May 7th and 8th. It's Tradier's Trader Fest. Kenny Polcari will be on our panel with us. That'll be on Friday the 8th. It's at what's it called? The PGA Resort, right, Bobby? Is that what that place is at? In lovely Palm Beach, which I'm looking forward to already. That's May 7th and 8th. Go to the Tradier Hub. You'll be able to find how to sign up. And what I always talk about on this show is Tradier Pro. Please scan that code and try Tradier Pro options trading platform for 3 months for free. We talked to people who've been trading options for decades, and some have been trading options for days, and they all say the same thing about Tradier Pro. It is the gold standard of options trading platforms. Now back to the show, Bobby.
So let me ask you from a stock perspective, something that the three of us, and by the third person is Mike Arnold, who's the third head of the holy trinity of the Unfiltered Investor newsletter. Caterpillar is a good example. I'll just use Caterpillar. As things were getting weak, we started to look at defensive stocks to recommend to our clients. Defensive stocks don't seem to have a valuation of traditional defensive stocks. I'm looking at the PE ratio of Caterpillar right now, 37.63. When we were talking about it, it was 41. How do you position yourself from an equity perspective if defensive stocks don't feel priced defensively? And do you see the mean of PE, for example, just moving higher, like, for example, the gold silver ratio did over time?
So I think it depends on your investment horizon. And I have different investment horizons now relative to when I was at Invictus. I mean, what I will say is, price to earnings ratios, valuations more broadly don't matter at all if you're looking out a year, and it doesn't matter what sector it is. They matter a little bit if you look at 3 years. They start to matter a decent amount at 5 years, and they matter a lot over 10 years. So I think my answer to that question is probably, it depends on what your time horizon is. And I will say to the second part of your question, I think that there is an asset shortage, just like there's a housing shortage. There's a shortage of stocks and every asset that's not government bonds that they're issuing. I think there is a shortage of. And so as a result, the price of those things relative to the income that they produce will probably go up over time. And I think if you look back, like if you go to the Shiller database and you look at the Shiller price to earnings ratio and you do a trend line, going all the way back to the 1800s, generally speaking, valuations have gone up in the US. Now, I think if you are catastrophically minded, you could make the case that some of the reasons that the US has been exceptional are changing. And so maybe that's going to mean revert. However, the market clearly does not believe that, at least not yet. And my base case is probably that valuations will oscillate, but they'll trend a little bit higher as time goes on.
You said something. You said asset shortage. Is that another way of saying global liquidity glut looking for things? Is that what you're saying?
It's just there's not enough companies. The number of publicly traded companies has gone down by half over the last 25 years. I don't think it's going to go up in the next 20 years unless policy changes. I used to know the numbers off the top of my head, but it's hundreds of thousands of dollars to be a publicly listed company. And for small cap companies, the types that used to IPO, it's too burdensome. And so they're not doing it. And so I think what you're seeing in the stock market is kind of like what you're seeing in the housing market, which is there's just not enough houses, there's just not enough stocks, but the amount of money keeps increasing and there's the amount of people spending money keeps increasing. And so demand over time is growing faster than supply.
So this is a fascinating topic, and I hope it's interesting to the listeners too, because when a company wants to expand and you think that they've been shut out by regulation and expenses to IPO, does private placement, does bringing on private money doesn't fall under the same category, so they can do that almost frictionless, right?
Yeah, I think it's been one of the reasons that private assets have grown really quickly and public assets have adjusted for valuations. There's not as many publicly traded companies.
That actually makes a crap ton of sense. I mean, I obviously knew that private equity was an enormous thing, but I wasn't really kind of putting it together. And I guess I have before, I'm sure, but it's pretty rudimentary when you think about it. Bobby,
is the crowded space of private equity part of the reason that there have been stories about it not underperforming over the last 5 years or so, or has it not underperformed on a relative basis?
I think it has underperformed. I think private equity is getting very crowded. And on top of that, it's competing with the S&P 500 where, it's compounded at like 15% for the last 10 years with a Sharpe of 0.6 or 0.65 or whatever. It's just a really hard benchmark to beat. And, there's been some academic literature that to achieve, accurate pricing for a complex asset, you need 3 or 4 informed market participants. Back in the day, I actually used to work for a BDC called Main Street Capital.
Well, what's a BDC?
It's called a business development company. Essentially, it invests. It's a public vehicle that invests in private assets. So MAIN is the ticker, but they would invest in lower middle market companies which have $3 to $10 million in EBITDA, and they tried to target companies that had closer to 3. They focused on the underserved part of the lower middle market. Even for these very small companies, relatively speaking, there were 10 or 20 bidders on most of these auctions conducted by investment banks. I mean, this is becoming a very efficient market. It's becoming a very informed market, and there's plenty of capital chasing it. So I think it's logical that over time, returns will degrade. And actually, if you look at the filings for some of the big alts like KKR or Carlyle Group, they'll show you their fund performance by vintage, and you can see if you were to impose a trend line on it. Very few funds are earning 40% net IRRs anymore. I'd say virtually none. And it's converging with what public markets look like. And in many cases, underperforming because the fees are so high.
Interesting. So by the way, for the public companies and regular old vanilla traded, public offering stocks, it seems like you're kind of bullish because you said before somewhat of an asset shortage. So are you bullish throughout the year? What if the situation in the Middle East deteriorates even more? What are your pitfalls?
Well, I mean, I think it's always helpful to have, you have to monitor the economic data and the fundamentals and the data as it comes out. And I think that will inform my outlook. of course, all of that tends to be lagging. So I think you also have to have some real-time market-based quantitative indicators for, whether dips are buyable or whether they're presaging something, more negative. Right now, I would say, again, looking 3 months out, I think forward returns still look pretty good. And one of the reasons that I say that is because, broadly speaking, credit health is still pretty good, especially if you exclude the impact of software. If you look at the software-heavy measures of credit health, like the performance of BDCs, which invest a lot in software, look a lot like private credit. If you look at triple C credit spreads, they look soft. Anything with a lot of exposure to software doesn't look great. If you exclude that, if you look at, for instance, investment grade credit spreads, they look more or less fine. And we have a model that I used to use at Invictus, and now I use it at Diamond Capital Management, that compares the volatility that you're seeing in stocks by using the VIX and the volatility that you're seeing in credit spreads. And the premise of the model, generally speaking, is that credit tends to be right. So when the VIX is going way up and credit spreads are not, generally credit's right, and that's bullish. And so we've obviously seen the VIX spike to above 30. Credit spreads have remained docile relative to the VIX. Generally speaking, that tends to lead well above average returns if you look, out 3 months or so.
Mike, what credit spread? What's the best chart to keep permanently up on one of your screens that measures real time movements in? I guess, and what type of credit spread would be the best? Would it be high yield? Would it be just AAA? What type of credit spreads really give you the quickest read on the economy and where the stock market could potentially go?
I like the two that I like are just the U.S. The Bank of America option adjusted high yield spread and high grade spread, and most of the time they look the same, but occasionally there are divergences, and I think those divergences can be informative. Like right now, high yield tends to have a little bit more software, looks a little bit weaker. Investment grade tends to have a little bit less, and looks a little bit stronger.
Interesting.
Mike, the old sort of smart money, or the old knowledge used to be, the old cliche was that when the retail and the sort of mob headed for the exits, that we were nearing the lows. Jill Carey Hall, who's a quant and equity strategist at Bank of America, she put out a note this morning, and it basically said this: clients were net sellers of U.S. stocks, driven by single stock outflows. All major client groups sold U.S. equities last week, led by institutional clients. Second week of outflows. Hedge fund clients were sellers after buying the prior week, and retail clients were sellers for the second straight week. She added that the outflows were almost entirely in large caps. Small cap and micro cap equities garnered inflows for the first time since mid-January. Number one, does that explain, in part, obviously that's not every client across every firm, but in part, does that explain, do you think, why the Russell has sort of outperformed in the last few rallies that we've had, that people think the rotation is actually going to take hold? And do you see that as enough of a sort of canary in the coal mine that everybody is selling and it's time to start to look to buy?
Well, I mean, I think it depends, again, on what your time horizon is. I mean, you're a better technician than I am. I kind of think that we're going to have, one more dip before we take off. So I don't know if I'm tactically that bearish. Almost all of my clients have a longer term time horizon than that, though, and they're looking out multiple years. And I would say even my intermediate term time horizon, 3 to 6 months, is pretty good. So, we're not selling stocks on the basis of my 2 week views.
All right, let me style this in a more general way then. In terms of technicals, today the Russell was the best performing asset for most of the day. It ended up being the NASDAQ by the end of the day, but the Russell was the best performing asset throughout most of the day, and it failed right at the 50-day moving average. Ran up to it, touched it, just barely touched it. The high today in the futures was 255, 25.57, and the 50-day moving average was 25.59.90. So basically ran up to it and then fell, pulled back. Gold, on the other hand, ran up to its 50-day moving average, didn't close above it, but tapped it, and it's just kind of sitting there. Those are the two. One of the pieces of commentary I put out, Jim and I both do commentary for CME Group. One of the pieces of commentary I put out today was that the next couple of days mattered tremendously for gold as well as for stocks. We got Trump's speech tonight. From a technical perspective, could you see those two assets leading the move back up and potentially reestablishing a bull trend, or does it have to be more broad?
I think with bottoms, you tend to see broader moves higher. That's my observation anyway. You know, I think there's two marks of a flush, you know, a 90% down day and a 90% up day. And we haven't really seen those yet. So, you know, that's not to say that we couldn't have bottomed. It's certainly possible, but it's not been a classic, you know, flush bottom, if you will. Like,
okay, let's go back to that for a second, because I want to make sure I understand it completely. When you say a 90% flush day, that means 90% of the stocks are getting hit. Is that what you're saying?
Yeah, 90% down, 90% of the Russell 3000 is down, or 90% of the Russell 3000 is up. You know,
okay.
those moves tend to, you know, represent, you know, degrossing and regrossing respectively, and sort of capitulation.
And how do you get that chart that tells you what percentage of the stocks are up and down?
I have a piece of software called Koyfin that shows it. I think Bloomberg probably shows it as well.
Okay. That's interesting.
Koyfin's got a free version that'll show that, Jimmy.
Okay, that's interesting to me.
Yeah.
Okay.
You got to do the pay for version to get more out of it, but Koyfin actually shows.
You know how cheap I am. You know, I have my first communion money in my wallet still. Anyway.
Don't tell Koyfin, but I'll pay and I'll send you the login.
Fantastic. By the way, didn't we talk to Koyfin about sponsoring one of our shows or events at one point in time?
I think we did.
Yeah.
I think we did. But I think it's interesting. People don't see that gold on its way down essentially touched the 200-day moving average, then had a long wick bounce on the upside. And since then, it's up 16.8%. Touched the 50 today, but didn't have the long wick down. It's just kind of sitting there. And I'm not looking at gold as the type of asset that shows you that risk assets are recovering. But I'm looking at it more. I think gold is to me still the best asset, because as we talked about before you even left Invictus, when you look at the factors that drive gold lower, longer term, I don't see them happening. You know, I don't see the Fed all of a sudden becoming a tightening machine and doing quantitative tightening for any long period of time. I don't see inflation going to negative 0.02. I don't see the Fed kind of sitting back and going, yeah, you know, we've got deflation. We're just going to leave it alone.
And you don't see the federal government slowing down the massive spending either, correct?
Again, the spending and Jimmy, the phrase you always use, stewardship of the currency, I think. Yeah. I
like when you quote me like that. It makes me feel important.
Well, you're smart sometimes.
Sometimes, everyone's
just offset by some of the times you're a raging dumbass.
Mike, do you have anything to add to that?
A couple of things. I mean, the first is, you know, sort of the technicals aside, I think gold is just a great asset to have a strategic allocation to, in that it's not correlated to stocks. It tends to have equity-like returns over time, or at least it has, and it performs better in inflationary regimes. And so, you know, if your outlook is that we're going to see inflation above 2 or 2.5% for a sustained period of time, we know the diversification benefits of bonds get worse pretty quickly when you're there. So what should you have instead? Well, history says a strategic allocation to gold makes a lot of sense. Now, if I could step back for just a second, because I didn't address one of Bobby's questions earlier about the Russell and the Russell maybe outperforming. You know, this is something that has been repeated over and over again, might be famous last words. I think this is a very reasonable period of time through year end for the Russell to outperform, because we're seeing fiscal stimulus, you know, directly being aimed at manufacturing companies and companies that are not the Mag 7, right? And I think that's why you're seeing improving manufacturing data. And if you look at the performance of the median stock, or even of the Russell relative to the PMI, the correlation is pretty good. So I think as you see the manufacturing economy improve, and, you know, the economic strength or the economic recovery sort of broaden out to stuff, you know, especially outside of technology, I think you could easily see the Russell outperform. I don't think that's unreasonable at all.
Well, I'm going to ask a question to both of you. One thing that I still have on the positive side on the ledger, looking at the stock market, is that I think the rotation out of the Mag 7, out of the AI trade into other things has been relatively seamless. And I know I'm saying that when the NASDAQ, you know, printed down 15, but much of that was the oil and the Fed painting themselves into a corner with potential stagflation. I think the rotation has been relatively good. Do you concur? And do you think that's a positive sign? And what stage of the rotation are we in?
Yeah, I mean, I think that's right. And it's hard for me to predict like the performance of the Mag 7 relative to everything else. I can tell you just on a personal level, it would make my job easier. I mean, it's
Yeah.
it's very hard to outperform any market where there's 7 stocks that are such large weightings you can't recreate those weightings yourself, and they're compounding at like 15 or 16% a year. You know, that's a challenging backdrop for anyone who competes against that benchmark. I will say, historically, you know, the stock market has been concentrated like this at other points. And when it gets this concentrated, you tend to see periods, you know, looking out over 10 years, very long term, kind of like valuations. The equal weight does tend to outperform. That mean reverts over the subsequent 10 years. And so I don't know if that 10 years starts now or not, but it's not unreasonable to think that over the next decade or so, you do see outperformance from the average stock or the median stock relative to, you know, large cap growth.
So you talk about a different sort of a time horizon now. Okay. So I think we talked about the business cycle briefly. Somebody's starting to invest now. First of all, outside of your responsibilities there, do you still get that question? Like, what do you think about the new man cow coin? Does that still come up with friends and family? Because it does with me.
No, about crypto?
Yeah.
I think crypto is dead in terms of sentiment. I tweeted something about Bitcoin that ended up being wrong. It got no engagement anyway. No one was even interested. So my observation is that sentiment in crypto is really shelled out right now.
Wow. So I'm going to give you a scenario of a fake person who's actually real. 28 years old, in the military, low 6 figures of money from the military, has it all in Roth IRA and everything else, and has a financial planner for that. And says to me, this actually happened, says to me, I've got about $50,000 that I want to take more chances with. I think I want to buy more NVIDIA. What would you do with the $50,000? Now, I gave him an answer, but I'd like to hear yours. This, by the way, is not financial advice for that guy.
By the way, what's his time horizon? Your guess?
He's 28, so I'm guessing 10 years.
It's an investment, not a trade.
Yeah, it's an investment. Just give me an area. I don't want to put you on the spot. I guess I just did.
I would say put it in the equal weight S&P 500. I think that's the responsible answer. I think if he has an edge in picking some sort of stock, it's impossible to make, you know, real money without taking some sort of risk. But if you don't have an edge, you're not taking a compensated risk. And so
it's just a risk.
It's just and it might be an uncompensated risk. I know people that have invested in meme coins for years, and it's an uncompensated risk. It's like jumping off a bridge. There's no reward at the end of it. And so, you know, if he's in the military and he's not a professional investor, I would say equal weight S&P 500 is a very responsible choice, especially at his age.
So what about, well, you know what? I'm not going to ask you that question.
Oh, what's the ticker symbol for the equal weight, Bobby? You've traded before, right?
What's that?
What's the ticker symbol for the equal weight?
Well, actually, when I look at that, I actually look at the small cap 600. So I look at, that's what I told him, if we're being honest. So I'm talking about SPSM. That's honestly what I told him, because I think that's more of mid cap. There's some technology in there. I actually just sold all of my SPSM about 2 weeks ago, and I'm probably going to get back in, depending on how tonight's speech goes, among some of the other things that are going on.
Our answers were really close.
What's that?
Our answers were really close.
I know they were. I think mine has a little bit more uncompensated risk.
But I love the way, Mike, I love the way you say things. Uncompensated, like you.
Notre Dame.
Yeah. What's that? He's Notre Dame. Exactly. We're a bunch of mutts compared to Notre Dame.
Right? Yeah. I don't know about that.
So what, Bobby and Mike, and I want to circle back to something that he mentioned before. Defensives were bid up, right? So when you look out through 2026 and you say equal weight, whatever, what are some specific sectors that you think may have underperformed and could play catch up very, very quickly in the next 8 months, 9 months?
I mean, I think if you're making a bet on oil going down, you could short oil. You could also buy stocks from oil importing economies like South Korea or Japan. I'd say that those have been terrific shorts, but the reason that they've been great shorts is the same reason that they'll be great longs if this conflict resolves.
That's interesting. By the way, that's a really good takeaway too, because I may look at the chart of Japan, because that I'm sure it's gotten pummeled being an importer nation, and that's interesting. But go on, yeah.
Yeah, Japan, Taiwan, South Korea has been a big one. I think the problem with that, in my mind, is that it's placing a bet on geopolitics, which I don't feel that I have a tremendous edge on personally, except to say that I think this conflict in Iran is politically very, I would say it's disastrous for President Trump into a midterms year when his platform was staying out of such conflicts. So I think you could make the case that as someone who's politically motivated, he will try and get it resolved with very quickly. So to the extent that I have a view, I think he's going to try and figure this out pretty quickly.
Yeah, he has to before the midterms. He's got to do something, right?
Right. So again, if you said place a 3-month bet on South Korea, I would be long rather than short. Even though, again, like I think the tape is pretty sloppy. I didn't like the close today, but that's more tactical.
Right.
I think it's Europe.
You go. No, I didn't mean to interrupt you. I thought you're done. Go, Mike.
No, it's okay. What about Europe?
Europe, I don't really have a
problem and all that.
I don't have a great view on Europe. I would say I'm generally not super positive on it. I think demographically, it's in a horrible situation. I think there's two drivers of long-term growth. There's people, and there's how productive those people are. And Europe has a shrinking number of people. They really have a hard time assimilating immigrants. I don't think there's very much appetite for that there. And they're also, their regulations make it difficult relative to the United States to be productive. And so where's the growth coming from? Like what can you be? The reason that I think Europe has outperformed is because they're spending a bunch of, they're trying to make the economy less rigid by throwing government money at different projects like defense. And that's better than doing nothing, which is why the markets have been going up. But it's not a long-term game plan for a productive economy. The government is not a good allocator of capital. It's good that it's allocating capital towards something that's not, completely ridiculous. But it's not going to achieve long-term economic results like a free market. And so, I would say generally we're long free markets or overweight free markets relative to Europe.
Yeah, so I want to address Remo's comment real quick too. So UConn. Okay, by the way, it amazed me. This is now this data analytics. We are the favorite going into this game. The last time we played.
By that.
What's that? I'm shocked by that too. The last time we played.
Before you do this, Jimmy, I'm sorry. Before you do this, as soon as UConn won, I was ecstatic because again, I had two nieces. One is at Illinois. One just graduated. One of my buddies down here that I hang out with all the time went to Illinois. You went to Illinois. So I was rooting for UConn because Illinois matches up with UConn really well.
And that's what the
market don't with Duke.
Oh, yeah. I agree with you. And that's what the market thinks. And the last time we played UConn this year, they beat us by an amount that makes Donald Trump's exaggerations look reasonable. They beat us by like 500 points, I think, when we played them at the Garden earlier in the year. And we're the favorite by 3 points, which I am absolutely shocked by that. But, Bobby, I'm going to give you the last economic question before we devolve into Notre Dame and them getting left out of the playoff and things like that.
Because I have the perfect question.
Go.
Pick 2 out of 3, Mike. Non-farm payrolls, ADP monthlies, jobless claims. What matters more? Like if you had to pick 2 of those as your composite labor view, what would they be?
Non-farm payrolls and jobless
ADP
claims.
monthly or jobless claims. You'd take non-farm and jobless?
Yeah, I would take the BLS data over the ADP data. Yeah, I think it's more accurate, and I think that policymakers care more about it. And I think you can't not take jobless claims because that's the highest frequency look that you have at the labor market. And of course, if jobless claims spike, almost nothing else matters, right? That's a bad scenario.
What about JOLTS? And by the way, in the past, you've turned me on more to JOLTS as a directional thing, not as the absolute number. But if it's moving in a certain direction, that's relatively believable because it's very, very low survey response. But I'd like to look at the quit rates a lot, and the quit rates went down, considerably, not considerably. Quit rates went down on yesterday's reading. To me, that's a big deal, and it shows that the labor market is still weak. Do you still look at the JOLTS?
Yeah, I like the JOLTS report. The thing that I dislike most about it, the survey response thing is a problem. It also comes out on.
I don't like the response rate on it
right.
at all.
Yeah.
It also comes out on a lag. It's so late that it's helpful for informing your bigger picture view, but it's never going to drive the markets one way or the other.
Interesting. And what give me another couple data points that other people don't, because I look at small business optimism. I'd probably give it a little more weight than most people do. What are a couple data points that people don't give as much weight to as you do?
Probably a few. I mean, I would say I spend a lot of my time on market-based indicators of stuff, trend, momentum, volatility, that sort of thing, just because the economic, the economic data is slow. It's very hard to forecast. I have views on all of these things, but if the market doesn't agree, then the view doesn't matter all that much. On the labor market, I like the Kansas City Fed's Labor Market Conditions Index. It's a composite of 24 different labor market indicators. I think sometimes it's easy to get overwhelmed by all the data that's out there, and it's difficult to prioritize, which is which and everything. And that's a great way of getting all the data at once and turning it into something that's useful. I would say probably, if I have an edge, more than having an indicator that's better than other indicators, I think it's understanding the sequencing of historic business cycles and how, interest rates tend to lead, housing tends to lead, manufacturing tends to lead, and so on and so forth. I think the sequencing is more important than any one of the indicators. And then you can look at the constellation of, housing data or monetary policy or manufacturing or whatever, and you can put it in the context of the business cycle. And sometimes it's not as useful. For instance, with COVID, it didn't matter what the business cycle was doing because there was this big exogenous event that sort of rendered it useless. But in a normal economic environment, I don't know that there's anything more important than understanding the business cycle and how it tends to progress over time.
Love that. That's a great answer. So now, when Notre Dame was left out of the playoff, what level of anger were you?
I was disappointed, but I don't follow sports as closely.
We got to get you following sports more. Okay,
it's a weakness.
Yes, yeah, particularly as a Notre Damer. But Bob, you got any last words, or should I play us out?
Good. Mike, thank you so much, buddy.
Thank you. It's always great talking to you, because you know why I like talking to you more than many other people is that you are reasonable and unflappable. And so many other people let their emotions push them into this binary, like, oh, everything's shit, sell, 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 like a Jim Cramer sort of thing, where you is like, no, let's look at this analytically. Like, I'm not convinced you're not AI, because you are very logical. And you're very, very, so maybe, and I've never met you in person yet, although we've talked probably 10 times. But anyway, thank you so much for being here. Where can the people find you?
So I work at Diamond Capital Management, which is the wealth management division of the National Bank of Indianapolis. So we provide investment management services to high net worth families and institutions in the Indianapolis area. So you can find me on the National Bank of Indianapolis and Diamond Capital Management website, and you can also find me on Twitter at Invictus Macro.
Okay, that's awesome. Okay, before I go, I want to remind people again, May 7th, May 8th, Tradiers Trader Fest in beautiful Palm Beach, Florida at the PGA National Resort. Bobby and I will be there with our buddy Kenny Polcari. It is almost too much Dago in one panel, but it's not. It's just under the limit, in my opinion, because there's enough room
too much mozzarella cheese and something.
Yeah, there's no such thing. Garlic. Too much garlic. There's no such thing as too much garlic. Just keep putting it in, but it'll be fun. We're gonna have a great time, and we will be at the bar. That's Friday we're talking. So Friday night we will be at the bar, and Bobby's buying all drinks around him. I'm just joking, but I'll buy around. But anyway, thank you guys for joining us. This is Tradiers, the Trader's Edge. I'm Jim Iuorio. That's Bob Iaccino. That is Mike Singleton.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.